Scott Groves with another mortgage mystery. What is PMI, or private mortgage insurance? We're going to link up here and below to another series of videos that we did explaining what FHA mortgage insurance is and what your homeowner's insurance is. However, it's very important in certain situations to understand what PMI, private mortgage insurance, is on a home loan. PMI, or private mortgage insurance, is simply the cost or the premium that you pay as a home buyer if you're putting down less than 20%. So, if you're putting down less than 20% on the purchase of a home, the lender considers there more risk in the transaction and they're going to charge you some amount of PMI, private mortgage insurance. Now, what can get very, very confusing if you're putting down less than 20% on a home loan is there's a lot of different ways to express that cost known as PMI. You can have that cost baked into the interest rate on the loan. So maybe the lender will move your interest rate from 3.25 to 3.625. You'll make a higher mortgage payment through the life of the loan, and that's how the lenders compensate themselves for the additional risk of you putting down less than 20%, and they bake the private mortgage insurance cost into the home loan, into the interest rate of the home loan. Or they might charge you a one-time large fee up front to cover all the cost of the PMI at the time of closing. This is probably our least frequently seen option because the thought is if you're putting down less than 20%, you probably don't have the extra money to pay a large fee at closing to pay for all of your PMI up front. The most common way that we see PMI expressed or charged on a home loan is as a separate line item and a small fee that you pay every month to the bank for the right to get the loan without putting 20% down. Now, depending on the logistics of the loan and the type of loan you're getting, that private mortgage insurance will fall off either when you refinance because property values are higher, you petition the lender and let them know that property values have gone higher and you may have to pay for an appraisal, or if you pay down the loan through the natural course of the loan, and again, depending on the loan, you get to an 80% loan to value or a 78% loan to value, depending on the initial terms of your deal, that mortgage insurance will fall off. So eventually, when the house is worth more, if you've paid down some of your loan, that mortgage insurance will go away, but it's a very important cost to understand up front. So if you're putting down less than 20%, private mortgage insurance is going to kick in, and it's a little bit of a misnomer because it doesn't insure you, the buyer. It insures the lender against you, the buyer, potentially walking away from the property. And then the mortgage insurance would kick in and pay off a certain percentage of your loan so that the lender, even though they were taking more risk, giving you a home loan with less than 20% down, they're made whole and they get their money back. So it's an insurance premium that you're paying to protect the lender because you put down less than 20%. If you have any questions about getting pre-approved for a home loan or buying a house with less than 20% down, reach out to our team. We can walk you through the whole process, help you with the mortgage pre-approval, and if for some reason our team isn't licensed in the state where you're looking to buy a home, we can refer you to a world-class loan officer in your area. Scott Groves with the Mortgage Mystery Series. Leave us a comment, shoot us an email, book some time on our Calendly if you have a question about a mortgage, need to get pre-approved, or want to see a video here on this series about a topic that's confusing you about the mortgage industry and buying a house.